Welcome to this deep dive. Usually when you think of successful algorithmic trading, you picture, screens full of green, massive numbers, and Wall Street level payouts.
Oh, yeah, definitely. That is the dream. Right.
Right. But today, well, we're jumping into a raw developer's test log from May 21st. It details a three-way parallel test of MT5 LLM auto trading bots. And the grand total net profit for the entire portfolio across the whole day is exactly 60 Japanese yen.
Yeah, 60 yen, which, it sounds completely meaningless.
Exactly. But our mission today is decoding this test log for you, because underneath that tiny, seemingly meaningless number is a pretty terrifying truth for anyone using automated systems. Basically, a high win rate can actually be incredibly dangerous.
Right, and it sounds like a paradox, but it is fundamentally true. To understand how that 60 JPY profit is actually a masterclass in AI risk management, we have to look at the massive gains that were almost entirely wiped out.
Yeah, the math only makes sense if we start with the bots that were actually pulling their weight. So the biggest winner of the session was a bot called LLMBridgeTrader on EURUSD.
Yeah, that one performed beautifully.
The developer bumped its lot size up to 0.02, and it closed 4 positive trades, bringing in a total of 824 JPY.
And it achieved that by playing smart. It doesn't just blindly fire off buy or sell orders based on a single indicator.
Right.
It actively evaluates its own confidence level, looks at the specific setup type, and generates internal trade reasoning before it ever makes a move.
Wow, okay. Then, on the complete opposite end of the spectrum, you have the second bot, which is BoundSniper, trading USDJPY.
Yeah, a much quieter approach.
Right. It pulled in a quiet 93 JPY on a tiny 0.01 lot size. There's no complex AI reasoning happening there at all. It simply executes external signals via TradingView webhooks, just no drama whatsoever.
Exactly. It is purely mechanical. It receives the signal. It takes the trade.
So BoundSniper is essentially like a thermostat, right? It just reacts to a set temperature and flips a switch.
Yeah, it's a good way to put it.
But LLMBridgeTrader is more like a meteorologist. It's reading the barometric pressure, looking at the radar, and making a calculated prediction before it acts.
Spot on.
But wait, if both of those bots were printing money all day, the math isn't mathing. Where did all the profit go? What was the weak link?
Well, the weak link was an AI doing what humans actually do best, which is doubling down when they are wrong.
Oh, no.
Yeah, that brings us to GateGrid AI trading GBP/USD. This bot completely hemorrhaged money, ending the day at negative 857 JPY.
Wait, let me look at this. Because if I'm reading the log correctly, it says GateGrid won many small trades throughout the day.
I did, yeah.
So shouldn't that buffer the loss? How does one bad run wipe out a whole day of winning?
What's fascinating here is the architectural flaw of grid-style systems. You see, GateGrid AI uses a two-level grid setup. When a position goes negative, instead of cutting its losses, the bot opens a second position at a worse price.
Wait, really? It just doubles down?
Exactly. The logic is that it hopes for a market bounce to average out the entry price. That way it can break even or scrape a tiny profit.
So it's essentially trying to mathematically force a win by adding more weight to a losing position?
Precisely. But the market didn't bounce. It caught an adverse straight line drop.
Ouch.
Yeah, that second grid layer didn't hedge the risk. It aggressively multiplied the damage. The bot triggered 2 massive late-stage losses, minus 688 and minus 744 JPY.
Wow, that is brutal.
Those 2 trades vaporized over 1,400 JPY of profit in minutes, literally erasing almost everything the other 2 bots had built.
So a 95% win rate means absolutely nothing if the remaining 5% blows up your account.
Nothing at all.
What's the takeaway for you, the listener, if you're automating your own setups? Chasing a high win rate clearly isn't enough.
Well, the developer's notes point to a strict mechanical fix. You don't necessarily abandon the grid entirely, but you must make that dangerous second layer conditional.
Like how? What kind of conditions?
For example, you code the bot to block the second grid entry if the longer-term hourly charts, like the H1 or H4, show a broader trend moving against your setup.
Okay, that makes sense.
Or, you stop it from adding positions if the average true range, the ATR, expands too quickly, because that signals violent volatility.
Right, so you have to build in hard-coded fail-safes to protect the system from its own logic.
You have to.
Sometimes you zoom out, and that tiny 60 yen profit isn't a failure at all. It's the only thing keeping the whole portfolio from crashing down.
Exactly right.
Which leaves you with this thought to mull over. If developers are constantly having to add these strict, hard-coded rules to stop their AI from stacking bad trades during sudden market shifts, at what point does an AI become so tightly bound by its risk management cage that it loses the very intelligence it was built to trade with?